Hello everybody and welcome to this new video entitled my 10 stocks, my 10 best stocks in my portfolio. And I want to cover mostly my top position and my top stocks, and I also have 3 bonus stocks because I've removed banks and I've removed Airbnb as well from this spreadsheet. So I want to focus on some other stocks. So let me just get started and describe the spreadsheet. So the way this spreadsheet works is it's my style of investing, which relies on enterprise value over gross profit, over revenue growth. And the question that I'm asking is, how much am I paying for that future growth? How much am I paying for each percentage point of future growth? And it is a spreadsheet that's very growth biased. And this metric is going to be all about growth. And if I input low forward growth, low next 12 months forward growth on this metric, I'm going to have a very, very unappealing number. And this is what is happening to Tesla in this spreadsheet. So Tesla is my number one position, but Tesla's growth, of course, has kind of hit a little bit of a snag because of the interest rate environment. And of course, today's Fed meeting, Fed bluff, it's a bluff, it didn't help, right? Even though the Fed, they said, oh, we're not going to raise rates anymore. We may drop rates towards the end of the year. They keep telling us that they are not going to drop rates in March and that now it's going to be in May. And the question is, do you believe the Fed, right? If you had believed the Fed in 2020 and 2021 and you had made investments based on believing the Fed, not thinking about raising rates, if you had listened to the Fed, made investments that way, and listened, you would have lost a whole bunch of money because you thought interest rates were going to stay flat until 2025. So now it's the same way. If you believe the Fed's not going to drop rates in March, they may do it. They may do it anyways, right? You'll likely know if they drop rates. You'll likely know the day before they drop rates is when you'll know, especially when we see what's happening to that New York bank today who had acquired Signature Bank down 40%. Maybe we have a banking crisis 2.0 brewing because of them ending the BTFP program pretty soon. So we'll see what's happening. Anyways, the reason why Tesla is not growing very fast here, analysts are predicting 21%. That reason has to do all about the interest rates. All about the interest rates. Interest rates are high. People are delaying car purchases. But in my view, there is no doubt that this will come back because it's all about the product, and the product is 10x better than anything out there. The product is the leading electric vehicle, and vehicles are leaps and bounds ahead of gas cars on so many levels. The chief reason why you would get an electric car is, of course, the cost. They cost about 10 times as little to operate than gas cars, and there's many other reasons why you would get them. The stock looks expensive on my spreadsheet, but I keep buying it at these levels because it is much cheaper than it used to be, and it keeps getting cheaper relative to where it was, right? The company keeps getting stronger, the balance sheet keeps getting stronger. Keep in mind, for a top 10 company in the world, there are very few top 10 companies in the world that still grow at a 21% rate. If you saw Google's earnings today, a company like Google is not growing nearly as fast. I am as confident as ever in the long-term future of Tesla. Short-term, I have no idea where this is going to go short term, and that's why I don't go all in right now. But if it drops to 170, 160, I'll be ready, and I'll probably be doing some long term leaps. You have June 2026 leaps on Tesla, and I find those very, very interesting because by then, in my view, the anticipation will be all about the Model 2. Anyway, moving to another stock that is impacted by the high interest rate environment, and that stock is obviously Enphase. Enphase, same thing, putting $30,000 worth of solar panel on your roof. Typically, people get that finance. Interest rates are high, and therefore they don't get it financed as much. But that's a temporary situation. I believe once interest rates go down and once electric utility rates inevitably go up, people will rush again to adopt solar. Whether it is solar energy, solar photovoltaics for your roof, and for Enphase, that play is you're doing the play on microinverters if you buy Enphase, which is the little device that turns DC current provided by your solar panel, that turns it into AC current usable by your home. That's what Enphase does. if you believe interest rates go down, and if you believe utility rates will go up inevitably because of the way utilities work and of the way inflation works, and the desire to charge more by legacy utilities who think in rent-seeking ways, then it's like a spring. It's like a coil, like a pressed coil getting ready to explode, right? You have interest rates pressuring on one hand, and then on the other hand, you have utilities raising their rates, and this technology is just getting cheaper and cheaper. And I believe if these stocks still grow through waves, that's because of the interest rates. But as soon as the interest rates go back to near zero, these stocks, in my view, will keep outperforming. And Enphase is my second biggest stock, actually, but it is not my second biggest position. My second biggest position is Bitcoin. And if you ask me, perhaps over the short run, the asset that I'm the most bullish on over the short run is Bitcoin. There's no asset I'm more bullish on. The reason why I'm so bullish on Bitcoin is because we have the halving in April. And that means that the new supply of Bitcoin will get cut in half. And now keep in mind, we have more demand for Bitcoin because of a Bitcoin ETF. We have demand that keeps coming for Bitcoin. We have advertising from these ETFs that is beginning. A lot of people are trying to acquire Bitcoin. We have investing managers, financial advisors that are putting 1%, 2% Bitcoin in their clients' portfolio. So the demand of Bitcoin in a secular trend is going to increase, and the supply is going to be halved. The supply is going to be halved in April, which means that I'm very bullish in the short term on Bitcoin. Of course, most of my Bitcoin is in pure form, owned in a Braden wallet, right? It's just a code you memorize, and then boom, the Bitcoin is in your head. But I also have some GBTC that I bought actually at a discount, and the discount got closed now that it's an ETF, but I'm not selling, of course, because I don't want to pay capital gains. And really selling Bitcoin is not part of the ethos of Bitcoin. If you're an old Bitcoin person like I am, you may know I was involved in Bitcoin in 2015. So I'm kind of like an old school person, an old school Bitcoin person. Bitcoin is not money. Bitcoin is Bitcoin. A little bit like if you're a farmer. Land is not money. Land is land. The same is for Bitcoin. Bitcoin is not money. Bitcoin's property. Bitcoin is Bitcoin, but it's a digital property, right? And I own CleanSpark and Riot and MicroStrategy too in my brokers, mostly because they're all leveraged plays on Bitcoin. They're leveraged plays on Bitcoin, and they're also stocks on which you can tap margin if you ever need to, right? So one thing that is still a little risky to do with Bitcoin is, of course, to pledge it for margin. You have some platforms that do it, like Abra, for example. You could place your pure Bitcoin in the custody of Abra, and then you could borrow against your Bitcoin. You still can't do that in a way that is safe enough for me to be comfortable moving Brain Wallet Bitcoin into a service somewhere. But I'm comfortable doing that if it is Bitcoin hold through MicroStrategy or through CleanSpark or through Riot blockchain, because these companies have margin enabled, and you can do a little margin. I don't have any margin drawn on them, but if opportunities come in the market, you never know. You never know what can happen. Is there another bank crisis brewing over the next few weeks? I mean, I don't know. So you never know what can happen, and it's good to have a little margin available just in case, right? And some people don't want to use margin at all, and they just prefer to have a bunch of cash sitting around, and that's fine too. It's just not what I do. So moving on to HIMS. So as you know, HIMS. I've praised HIMS so many times on the channel. It's my cheapest company that I own, the cheapest company that I cover in the channel, the cheapest company that I've ever seen. Actually, I can't understand how cheap this company is. It's trading at a 3 times gross profit. It's predicted to grow at 60%. Gross margin is 82%. Keeping in mind that this is a company where more than 90% of their sales are recurring. So really, when you have mostly recurring sales, you should be trading closer to a SaaS company like CrowdStrike. Look at CrowdStrike. CrowdStrike is 10 times more expensive than a HIMS on a price to sales basis. Now I still own CrowdStrike, but HIMS grows 50% faster than CrowdStrike, has better gross margin. But of course, it is a small company and it is dismissed because most people don't understand HIMS. HIMS is very simple to understand though. It's an e-pharmacy plus an e-doctor, electronic pharmacy, electronic doctor without insurance. That's all it is. It's electronic pharmacy, electronic doctor, without insurance, without all of the bureaucracy that goes attached with insurance. And because they don't have insurance is the reason why they grow so fast, in my view. They grow so fast because they operate fully outside of insurance. They are creating a consumer brand in healthcare. Consumer brand in healthcare is what they are doing. And the cheapest stock ever, in my view. I mean, at a 0.04, it's been this way for over a year now. The stock has been this cheap for over a year, but it keeps being cheap. Stocks can stay cheap for a long time and they can stay expensive for a long time, which is why I think on an absolute basis, one should not care too much about, say, the price to sales ratio. But if your sales increase 15%, 60%, 50%, 60%, so your sales increase 60%, your price to sales stays the same, then in theory, your stock should grow 60% too. Because if your stock doesn't grow 60%, but your sales have increased 60%, then you've just experienced ratio compression. And the ratio you can't have compression on your firm's ratios indefinitely. When you start having too much compression in your firm's ratio, you start having behaviors like we see for Enphase, HIMS, or StoneCo. I'll get in a minute. That behavior is these companies start doing buybacks, right? These companies start doing buyback. They start thinking, oh, wait a minute, my stock's way too cheap. I have this money. I might as well buy back my stock because it's so cheap. And sometimes buybacks are very illegitimate. Like, for example, I don't think it would be a good idea at all for Tesla to do a buyback. I don't like that idea at all. But I'm sorry, but for a company for HIMS, even if it's a buyback at their scale that they announced, right, a $50 million buyback, it's at their own scale. It's a legitimate buyback when you're the cheapest stock out of maybe close to 40 stocks that I follow regularly on the channel. It's the cheapest. So it's legitimate for him to do a buyback. I'm very much into this stock. I like that the stock hasn't run up at all in the little rally that we had in fall 2023. It has barely run up. The stock is still cheap, and I like it very much. Moving on to CrowdStrike. CrowdStrike is a problem stock for me because I've tripled my money on it now, and I obviously don't want to sell. I'm not a seller. I don't like to sell stock. And whenever I try to sell a stock, I regret it. Insert NVIDIA, right? I sold NVIDIA. I thought I was real smart. I thought I made a big profit on NVIDIA. Turns out not smart at all to sell NVIDIA. And you can bet I'm not making that mistake on CrowdStrike. I am not selling my CrowdStrike, even though it's tripled. It has tripled from when I was covering the stock. CrowdStrike, by the way, is the leader in cybersecurity, in cloud-based cybersecurity for your endpoint devices. So it is quote-unquote an antivirus. That's what CrowdStrike does, but it's a cloud-based antivirus, and they have the biggest network of endpoint devices, i.e. mostly computers. The biggest network of computers use CrowdStrike, so if you have a breach somewhere, if your computer gets a breach, then CrowdStrike can update all of their computers in their network and then fight those breaches. And it's a very powerful setup. It's a winner-take-most setup. I've always loved CrowdStrike much better than SentinelOne just because the way it works is the company who has the most data is the company that wins. And clearly, to me, this company is a winner. Let me move on to Mercado Libre. Mercado Libre is a stock that I almost never ever cover individually on the channel because there's not much to cover. They are the leading e-commerce player in Latin America. This is a company that keeps delivering outstanding results year after year. They are unchallenged. Amazon is way behind. Sea Limited, when they tried to go to Brazil, they didn't even make a dent in the local giant. The local giant in Latin America is Mercado Libre. They also have a thriving fintech division. They have an exciting advertising division. It's like Mercado Libre is like they're running a mini Amazon. They have a logistics division. They're running a mini Amazon without the cloud business. Without the cloud business. And I may hear people in the comment section saying, well, why would I invest? Why would I want to invest in that? Well, because most people who own Amazon, they say they own Amazon for the cloud business because they look at the e-commerce business, and the e-commerce business doesn't make that much money yet. But that's just because they haven't turned on profitability. Once Amazon turns on profitability on its e-commerce, I believe it will be doing amazing. And Mercado Libre is kind of the same. Once they actually turn on that profitability and they stop being in their growth mode, and once that growth rate, which is still predicted to be 35% next 12 months, once that growth rate, gets closer to the rate of the economy, is when these companies start raising their commissions and raising their margins, and when you start earning outsized returns, right? All of these companies here, none of them are at a mature stage. They're early, and so they invest in their growth, as evidenced by the average revenue growth that I'm presenting to you today in this spreadsheet. That average revenue growth is 51%, right? 51%. So if you own a portfolio like this, and they all grow 51% over the next 12 months in their sales grow 51%, and the price to sales ratio stays the same, in theory, it should track. It should track closely. Revenue and stock price should track each other pretty closely in theory. And if they don't, then you have a compression, and that would be in that case a compression of more than 50%. And you can't have compression forever, because eventually the market starts to notice. So that's why I'm supremely confident in these companies. This is no financial advice, no stock advice whatsoever. It's just what I do. Moving on to StoneCo, Stonier, ticker symbol Stonier here. I love Stonier. Stonier is the second cheapest company in my universe. Stone is the Square of Brazil. It's the payment terminals of Brazil. They have a multi-fold expansion plan. They've provided tremendous long-term guidance. They have a buyback in place now. I like to joke they're in the business of accumulating cash. I can't wait for them to report their next quarter. That will likely be my next update on StoneCo. But StoneCo is a fallen giant that has to get back up. And when I see these numbers, predicted revenue growth 45%, 74% gross margin. When I see how leading they are in Brazil, 3 million small businesses use their payment devices. They also have a payment devices for micro businesses, which is based on the app. We really don't have that many micro businesses in the US, so we may not understand as well what a micro business is, but for StoneCo it makes a lot of sense. And they set out a very, very compelling vision for the next 5 years if you look at their investor day, and it's a stock that I'm very happy to own. My only sadness with StoneCo is that it's up 80% from when I was actively buying the stock about 6 months ago. And so that's like the only downside. It's up, and it doesn't feel good to pay more than what you used to pay. But then on the other hand, I'm accumulating Tesla right now, because Tesla I'm paying way less than what I used to pay. So that's just the game of the market. It goes a long way to say that you should really not. DCA is really the most powerful strategy, because some stocks are going to be cheap, some stocks are going to be expensive, but over the long run, it's all about the fundamentals. At least in my view, over the long run, it's all about the fundamentals. Now, let me move on to my bonus stocks. Now, keep in mind, Celsius is a stock I used to own, and I sold Celsius for a profit. Again, a mistake of the youth. What can I say? I'm buying back Celsius now, and I've started new positions. So one of them is in Enphase. If you follow the channel, this will be my third time covering Enphase in about a week. So briefly, Enphase is a radio pharmaceutical company. They sell. They have mostly one drug that is based on radioisotopes that stick to cancer. And what you do is that you take the drug and it sticks to your cancer in your body. And when you go to a scan, you avoid these false negatives, which are often the plague of cancer patients. As you go see the scan, you see nothing in the scan. And oftentimes that's because cancer was missed. And so I think Enphase has a very compelling product, and everything I read about it and all of my indications is that they have a blockbuster drug. And blockbuster drugs to me are very powerful. I actually was an investor in AbbVie. AbbVie was the maker of Humira. And I remember making a great return on AbbVie, even though it doesn't seem like the type of stock I would buy, but they had that blockbuster drug. What if that is the case for them? And it seems to be the case for them. And the market is entirely ignoring it. Why are they ignoring it? Because look at that price, right? It's trading at under 1. So it's a special company. It's it sits right along StoneCo and HIMS, except, and there's another company that I used to cover on the channel. You may remember when I was covering Lovesac, what I used to call the disruptor of recliners. You may say, what about Lovesac? Lovesac also trades this cheap. Well, yes, but let's face it. A lifestyle brand that sells furniture, to me, is less meaningful and has less of a total addressable market than a drug that is revolutionizing a space of pharmaceuticals related to cancer. I think when you start thinking critically about the issue, to me, this is a bigger total addressable market, much bigger total addressable market, because you're in the health sector, and the health sector has entire mega trends, right? The mega trend is, of course, people are getting old and people need more and more medical care, right? If you look at a stock like furniture, for example, you have less and less people still buying furniture because household formation is at an all-time low all over the Western world. And it's great, it's a disruptor, but it's not as big of a disruptor as, say, a company like Enphase. Let me talk to another company, which is TransMedics. And TransMedics is also a company that you may remember me saying not for me on this channel, and I must say that I did more research and I was misinformed when I made the video on TransMedics about 3 months ago, and I was saying that I was uneasy about organ transplant and this idea of organ transplant. Well, I still don't like the idea. I still think it's a very sad way to earn revenue, and it's not fun. But the more I read about organ transplant, someone has to do it. Someone has to do it, and the current system, which is dry ice, and by the way, TransMedics has invented as the only FDA-approved organ care system, which keeps organs alive for multiple days, and it looks like an artificial womb, and it mimics the body, and you put the heart in there, or you put lungs in there, and the lungs or the heart will think it's in a body. And the machine, the organ care system, is the only machine that can do that. And it expands the life of an organ by a matter of days, which allows for much, much more success in the delivery of organs to people who wait for organ donations. And when you're waiting for an organ, if you don't get that organ within the right period of time, you're going to not make it, right? You're going to die. So this company is actually revolutionary in the sense that a lot of these organs in the old dry ice system would just end up dying. The organ ends up dying in the ice and never ever transferred to a patient. So that's a 0-to-1 move, that product. That company did a business model innovation. They did a business 0-to-1 move too when they acquired an airline. They just acquired it was a flight school / airline that had chartered jets, and they just acquired it because one thing that you learn when you study TransMedics is that many organ transplants do not happen because hospitals can't get their hands on a private jet. They can't get their hands on a private jet 1 day out of 3. There's 1 day out of 3 where you can't buy a jet to move you can't rent or charter. You can't charter, whatever. You can't charter a jet about 1 day out of 3 in the US, because whenever, say, you have a sporting event, all of the jets in this country are taken. And so if you happen and if you happen to have a great organ donor, and it happens to be the Super Bowl, well, that's bad luck. That's tough luck. The transfer can't happen because you can't get your hands on the jets. to have the surgeon and to have the organ meet, if that makes some sense. So it's actually crucial for them to grow their business that they acquired this airline and these pilots and these private jets. It is crucial for them. So it's a fascinating business, and as much as it is a sad thing, the way revenue enters, the balance sheet of this company, the balance sheet, the income statement, sorry, the way revenue enters that income statement, it starts with sadness. I would argue the profits end with a happy news, which is a successful transplant and a person that gets to live on. So I've grown on this. And I've evolved my philosophy as an investor. And of course, what's the best indication that you have something special? Well, it's the revenue growth. And look at the revenue growth, 122% predicted revenue growth. It's insane. It's the highest that I cover on this channel, and it's outright insane. And the final company, talking a little bit about disruptions that I guess are less meaningful than the two health stocks I just show you, health tech stocks, is Celsius Holdings. Celsius Holdings is competing against Monster, competing against Red Bull, and they are extremely popular in the US. And if you pay attention to popular trends and popular culture, I was at... It's funny. I was at Ollie's the other day. I don't know if you know what Ollie's is. Like Ollie's is a discounter, and I was looking at and they have products that didn't sell, and they had a giant stack of all of the energy drinks that tried to compete against Celsius, and you could buy them for pennies on the dollar at Ollie's, like entire pallets. You could buy them for pennies on the dollar. Because of course Celsius is the winning energy drink, and whenever someone tries to undercut them, even if you sell an energy drink for like 30 cents or even $1 less than Celsius, people are not going to buy it. They are the premium brand in that space, and growth numbers don't lie. And the Pepsi partnership doesn't lie, and it it may seem shallow to think that investing in an energy drink compared to the meaningful innovations that I cover on the channel, right? Discussing about an energy drink seems a little meaningless, and perhaps it is, but nonetheless, it's a product adoption story. It's a drink that everybody seems to love in the United States, and usually the trends here usually get followed by a lot of countries, and I'm thinking about Europe here. I'm thinking that the culture in Europe is different from the US, but it's not that distant, right? Monster is a leading drink in the EU. Could this be the next leading drink? That's part of their plan, and we'll see that happens, but that's part of their plan. So I'm happy to be buying back in. Yeah, that's the last thing I should have said. The stock is cheap again. The stock has gotten cheap again, which I'm happy about. So anyways, these were the valuations. I hope this update is helpful. This is no investment advice, no financial advice, just entertainment. Hoping you were entertained. Please like, please subscribe. Thank you so much for watching, and have a wonderful day.